Let's start the week's conversation right now with MUFG's George Goncalves and Jim Bianco of Bianco Research. Jim, first to you. Great to catch up with you, buddy. Wednesday, what are you looking from Chairman Powell?
Well, I'm looking for, a lot of people are looking for, is that he'll push back on the loosening of financial conditions, that the stock market has been up a lot, bonds have recovered, and that he might be afraid that will spur a wealth effect. The issue, though, is how does he push back on it? The Fed's already said that they're within 75 basis points of being done with raising rates. Does he raise 50? That would be a shock, but he'd be done or very close to being done at that point. Does he open the door that the terminal rate might be higher than 5 1/4? That would be a major change. So I get it. He'll push back, but when you've already announced that you're almost at your target, there's not a whole lot of things you can push back with.
That's the question, Jim. George, help us answer it. If the Fed chair is asked whether we've seen an unwarranted easing of financial conditions, if he's asked that question on Wednesday, A, how does he answer it? And B, are you going to pay any attention to what he has to say?
Absolutely. I think he's going to push back to Jim's point. I think everybody else is kind of on the same page. It's hard to kind of just focus on the incremental rate hikes. He's going to focus on the cumulative effects of the 7 supersized hikes last year, and the fact that they're going to finish close to 5%. I think emphasizing on the level, they're going to stay higher for longer, and they're going to keep reminding us that maybe this is an opportunity to mention that the balance sheet is going to continue to tighten through quantitative tightening.
Well, George, you have the Fed going from hawkish to dovish pretty quickly. Why is that?
Largely because we cannot afford higher rates in the U.S., but I do think that the bond market is getting ahead of itself. First, let's kind of see if anything breaks before we pass judgment.
Picking up on what you've got to say on this, Jim, I think the narrative and attention should turn to how far down we're going to go, not whether inflation has peaked. Do you reckon the chairman's going to reinforce that on Wednesday?
Yeah, I do. I think that's been kind of his main message that's been lost. I mean, we've got everybody yelling peak, peak, peak. And yeah, inflation has peaked, but it wasn't going to stay at 9% forever. The real question is can it get to the Fed's long-run goal of 2% on its own without a recession? If that can happen, and still the 3-month rate on core inflation is still 3%, so it even hasn't achieved it yet. But if it can happen, then we could definitely see the Fed back off. But if we wind up seeing inflation bottom at a level like 3.5%, and then the base effects that are pushing it down by July start turning higher, then I think the Fed is going to be reinforced on this idea that they have to stay higher for longer and maybe even visit the terminal rate at that point.
Well, Jim, there's another question to put to this, and I think it addresses what you're trying to look at. It's whether unemployment, which is currently at 3.5%, needs to climb through 4.5% or maybe even higher to get inflation somewhere in the vicinity of 2%. Do you think it does?
Well, yeah, I think that is the key. The Fed has invented a new statistic called Services Ex Shelter to look at inflation, and that is driven by employment. But the problem with employment is, if you look at the big headline numbers, initial claims at a 9-month low, 10.2 million open jobs, 3.5% unemployment rate, like you said, there's very little evidence that there's a problem in the labor market now. Now, maybe one develops, and if the one is going to develop and we're going to get a 4.5% inflation rate or unemployment rate, say by mid-late year, that's a gigantic leap in the unemployment rate in 1 year. That would be not a soft landing. That would probably be a bigger than average recession to get it to rise that much over that short a period of time.
Well, claims last week were 186,000. George Goncalves, let me come to you on that. Mike McKee and I talked about this a little bit earlier this morning. At the end of August, the Jackson Hole address from Chairman Powell talked about the pain still to come. 186,000. If I'm looking at jobless claims, I'm asking, where's the pain, George?
Look, the cumulative claims are rising, although initial claims are not. And we have to ask ourselves, kind of the composition of the labor force has changed. And, it's still hard to tell if the tech losses that have been, mounting for the last couple of months, when are those job losses really going to show up in the numbers? So I think that we're living in this ambiguous time period. But yeah, I think, Jim's right that the fact that as long as those numbers hold, then the Fed has to stay on the hawkish side, at least maintain rates at a higher level until we actually see the labor market relent.
Equity futures right now down 0.8% on the S&P. On the Nasdaq, we're lower by 1.15%. Looking at the bond market, yields a bit higher throughout this morning. On the session, up 4 basis points on a 10-year to 3.55 on a 2-year on the screen, 4.25 on a 2-year, up 5 basis points. Mike McKee, central bank after central bank. It's not just the Fed this week, it's the BOE and the ECB.
Yeah, remember when the jobs report was a big number of the week. we have all this going on before we even get there. And it's important to keep in mind that this all matters because, as Jay Powell puts it, what happens in Europe or in the UK reflects back on the U.S. economy and vice versa, especially the U.S. Here's some context for you. This is where we are on the right-hand side as far as rates at those three central banks. The highest in 15 years, much higher than we saw. There's a little yellow bump there towards the left-hand side. That was the European financial crisis. That was the Eurozone crisis. You can see that we haven't had this kind of tightening in a very long time. So what kind of impact is it going to have on a cumulative basis? That's what has to be figured in. That's what the Fed will be talking about when they start meeting tomorrow. You take a look at what they're going to be doing. Pretty much the Fed is locked in at 25, and the ECB and BOE, the markets think, will do 50. And then the question is, when do they get to their peak rate and start going the other direction? Looks like the summer is the time for that. And the first cut would be November and December for the Fed and the Bank of England. 2024 is where the markets are maybe first pricing the ECB. So we're going to have high rates for longer, which is what the Fed wants you to believe. And this is where Jay Powell's going to talk about on Wednesday. He's going to be talking about not so much what the terminal rate is, not so much what they'll do at the next meeting, although he will definitely leave it open to raise rates and talk about being data dependent. But the idea is they're going to keep rates high for a long time. You were just talking about that because they want to make sure that they get down below 3%, get headed towards 2%. So their argument is going to be, we're keeping rates steady, and you got to buy into that. And as you can see from the yellow line there, the markets do not buy into that right now. It'll be interesting to see if that changes come Thursday.
Mike, just briefly, how do you think that takes shape in the statement that we get from the Federal Reserve? They have this line in there about ongoing increases. Does that change at all?
Don't think that one changes. I think they're going to talk about ongoing rate moves, because I think the reaction in the markets to any kind of change would be very counterproductive for the Fed at this point.
Mike McKee, thank you. 4 weeks of big gains in this equity market. Futures are lower right now by 0.8%. But check out the year-to-date moves we've seen so far worldwide. Euro Stoxx 50 year-to-date up 9%. Nasdaq 100 up more than 11%. EM equities absolutely flying. Big question too. Do you fade it or do you chase it? Wall Street and the big debate taking shape this morning. Morgan Stanley and JP Morgan on the one side saying beware of the Fed and telling investors to fade this move higher. HSBC and Federated on the other chasing the rally. If I pick two quotes, let's start with Mike Wilson and I'll compare that to Max Kettner over at HSBC. This is Wilson of Morgan Stanley this morning. We think the recent price action is more of a reflection of the seasonal January effect and short covering. Investors seem to have forgotten the cardinal rule of don't fight the Fed. Perhaps this week will serve as a reminder. That's one side of the debate. Here's the other. Max Kettner, HSBC, publishing this morning. Hawkish surprises could upset some of the bullish repricing. It won't take much to prompt a short-term setback for risk assets. This won't change our first half view. In fact, we'd rather increase exposure to risk assets during such setbacks. Jim Bianco, I want to come to you on that. Are you in the Max Kettner camp or the Mike Wilson camp?
I'm probably closer to the Mike Wilson camp. I've been trained to not fight the Fed. That has always been a good strategy. This market has been driven by the perceptions of liquidity and interest rates. And if the Fed is going to stay higher for longer and push back on the idea that easing financial conditions is not what they want, that is a tough thing to really fight against. And I think ultimately that is where the market is going to really run into trouble.
Nothing changes a consensus narrative quite like a 4-week rally in the equity market. George, your thoughts on which camp you're in?
Look, I'm also, I guess, in the more defensive camp as well. Look, it's a technical feature of the markets at the beginning of the year. We have also vol declining, so that's really allowing for investors to leverage up and really giving a false sense of confidence. And I'm concerned that investors are now going to extrapolate the sort of gains we had at the beginning of the year as really the start of a bull run. And in fact, this is just a bear market rally.
It's not just equities, though, George. It's credit, too. You see scope for wider spreads. High-yield spreads, you say, will widen, and yet spreads have been tighter over the last few months. George, why do you think that is?
I mean, because look, it really comes down to the fact that the economy hasn't really shown, severe cracks that will result in credit losses. I mean, and that takes time to kind of show up. So again, this is the kind of ambiguous time period between the peaking of a tightening of financial conditions from the Fed side, at least from raising rates, versus a market that doesn't want to believe it and has an inverted curve and expects them to cut. I mean, the two cannot last for too much longer. And I think the Fed's going to push back, and that's going to push cuts further into 24. I think you finally get a sell-off in risk assets in the back of that.
George, what will force the market to believe it?
Look, I think that a combination of either you have the growth impulse that's coming out of China, which everybody's hanging their hat on, that that's going to be a pro-growth, that maybe Europe is in much better shape, and that we don't get the weakness in the jobs market until later in the year, and the Fed just keeps talking the tough talk.
Or it's just the data. Andrew Hollenhorst, the City, talked about this morning when he published. He said, we expect upcoming stronger core inflation to challenge this most recent version of the transitory inflation narrative. Jim, I caught up with Andrew Balls of PIMCO last week. It wasn't his base case, but he certainly thought it was the risk for this year, that inflation just stays sticky, more elevated than people expect. When you speak to clients, how receptive, Jim, are they with that view?
They're kind of all over the lot when it comes to that view. There's a number of them that think that, inflation will get back to 2% and others that don't. But to your point, I think that is really the question. As I said earlier, it's not that inflation peaked. We know that. Is it going to 2%? And why would it be going to 2%, or why would it not be going to 2%? And ultimately, the discussion really comes around the reopening of the economy, both China and the West, in a post-COVID. Are we in a post-COVID economy, meaning it is not 2019 anymore? If that's the case, you could make the case that inflation will stay persistent above 2%. Or are we doing like the chairman of Boeing just said, oh, we're all going to return to 2019, and it's all going to be just like it used to be, and then the inflation rate will also go back to 2% as well. That's really the question. And I tend to think more in the persistent camp that it's a post-COVID economy. It's different than it was pre-COVID, and we're not going back there.
Or tech investors hopefully hope that we go back to 2019, Jim. To your point, have we seen real regime change? That's the issue right now for many people. Jim, George, sticking with us. Equities right now down by 0.75%. Coming up, fresh data giving Europe a dose of reality.
The market has now priced in a much better situation than it was supposed to be. There are still headwinds coming, and as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis.
That conversation, up next.
The market has now priced in a much better situation than it was supposed to be. Look at the performance of European stocks this year relative to US, so that the market has been buying into this far better than expected story for Europe. There are still headwinds coming, and as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis.
The recent strength in global equities facing a test this morning. In Europe, Spanish CPI coming in hot, German GDP coming in soft, souring sentiment and pouring some cold water on this year's optimism as the reopening rally stalls in China after 3 months of monster gains in Chinese ADRs, casinos and even airlines. The team coverage starts right now with Maria Tadeo in Brussels. Katie Lyons here in New York. Katie, first to you. The rally stalls just a little bit.
Yeah, once Chinese traders were back at their desks after the Lunar New Year holiday, we saw the worst day for the Hang Seng Tech Index and Hang Seng China Enterprise Index going all the way back to October, so about 3 months. We do, though, John, have to keep those moves in the wider context, which is that tech index is up 72%, or at least it was through yesterday, since its low in October, was trading at the highest in July. The Enterprises Index trading at the highest level since June before today. All of that, of course, fueled by the optimism about the Chinese economy reopening. Today, though, that Hang Seng China Enterprise Index saw all but 4 of the 50 stocks down on the day within it. The big underperformance from the big tech companies like Tencent, Alibaba, Bilibili, all of which dropped in the range of between 7 and 8.5%. Again, though, since the lows for these stocks going back to October, they have had astounding rallies. Alibaba up about 77%, adding $145 billion to its market cap. For Tencent, we've seen $250 billion plus added to its value. So perhaps it's not all too surprising to see some profit taking coming in here. A few analysts in research notes today have essentially said these tech and internet stocks are near the completion of their valuation recovery. Now they need earnings to fully support them. So we'll see if the fundamentals also support the outperformance of these stocks versus the rest of the world. The tech index up 11% so far this year. Asia stocks more broadly up 9%, and then the MSCI Emerging Markets Index, which of course China has about a third of the weighting of that, is higher by 9%. Compare that to a gain of just 6% for the S&P 500.
The move has been ridiculous. That's 4 weeks when we talk about year to date. That's 4 weeks. The 3-month move, massive over in China. Maria, I have to say, a bit of a reality check for the constructive view on Europe this morning.
Yeah, remember it was the start of the year. We had that call from Goldman Sachs. There won't be a recession. Today, the data, however, points to accelerating inflation. When you look at the Spanish print that came out today, we were expecting it to cool down. In fact, it accelerated. Of course, core inflation also seems to be sticky, although I should stress that core inflation is measured in Spain slightly different compared to its peers. This was the flash reading, so I really want to see the details at the end of the month. And then you have Germany pointing to a slight contraction. So accelerating inflation, and then Germany in a slight contraction. I should also note we were expected to get German inflation this week, and we are not going to get it because they've had, allegedly, I have a statement here from the statistics office, a technical problem. So they're not going to release it before the ECB decision on Thursday. Tomorrow, Jonathan, I think we're going to get a much bigger picture, however, when we get data from Italy, the French too, and the Euro area, just to get a temperature check of just how good or how bad the situation really is.
I don't even know what that means. A technical problem, putting out CPI data, but it is what it is. Maria, thank you, alongside Kaylee. Remember the ECB and a punchy Christine Lagarde in December when she said, we're not pivoting, we're not wavering, we have more ground to cover, we have longer to go, we're in it for the long game. Jim Bianco, do you expect a repeat of President Lagarde from December this week?
Yeah, you do. I think that the ECB was slow to get off the snide and moving rates, and now they're going to do some catch up. They're going to probably move 50, where the Fed is going to move 25. I think it's too early for them to really say that they've really got their inflation behind them. Yeah, maybe a peak like the U.S., but the question is it a persistently high level? So, yeah, I expect them to go more and not waver, at least, or give any signs of a pivot.
George, how sticky do you think the inflation story is in the Eurozone?
Look, it has potential to be very sticky, especially, as your opening comments mentioned, that it's not clear that Europe has resolved its energy problem. I mean, I think they've dodged the bullet from weather really helping them out. But, next year, again, as we get towards the winter, if China is fully back up and running, they're going to be competing for resources and energy as well. So it's like this. There's all these conflicting narratives out there that I think Europe has a much more structural problem of potential stagflation, or even if it's low level inflation, but still higher than what they're supposed to be.
George, to your point, that word, stagflation, why is it barely being used to describe what's taking place in Europe when it's in the numbers?
Well, I mean, I think there's, again, euphoria that they've dodged the worst case scenario. And on the back of that, I mean, the idea that we can somehow soft land, which really means no growth in the Eurozone, that to me is close enough to a recession. So I think there's this view that if we get into a kind of a growth slowdown, that it will kill the inflation and therefore you won't have stagflation on the back half of that. And I think that's, again, too premature to have that kind of conclusion.
The potential that we could get stuck down here with very, very little economic growth, Jim, and very, very sticky inflation in the Eurozone. What would guide your views on that?
Oh, I definitely think it would be more along the lines of whether or not they can get past their energy problem. As George said, they got lucky with weather. They've got huge inventories for coming into early February right now because they haven't had to use a lot of their gas. And the question is, when they get to the teeth of a normal winter and a normal usage, maybe next year, does that really start to make them have problems? So I think it's way too early to say that Europe is, not gotten past this. It might be delayed, the weakness that we're looking for in the European economy. But whether or not they've missed it altogether, I think it's too early to say.
That's what Jane Foley of Rabobank had to say last week as well, and I think we're all on the same page, Jim. Jim Bianco, George Goncalves, to the both of you, just fantastic, as always, on the global economy, on central banks, on monetary policy, and on the bond market too. Fantastic lineup later this week for you. On Fed Decision Day on this programme, here are the names for you. Kathy Jones, Bob Michael, Chris Harvey, Harvey, Mike Wilson. Then on to payrolls on Friday. Here's your lineup. Mohamed El-Arian, Rick Reeder, Anastasia Amoroso, and Mike Collins. So we've got Fed decision day, all-star lineup, and all-star lineup for you on Jobs Day in America this Friday. Is that enough for you? We keep going through the week ahead. Payrolls on Friday, the Fed decision on Wednesday, ton of data in between, and earnings from Amazon, Meta, Alphabet, and Apple. Coming up the morning calls and later. It's too early to get bullish. That's the view from Citi's Kristen Biddley, warning investors of more downside still to come. More on that around the opening bell. 7 minutes away from the cash open. Equity futures negative 0.75% on the S&P 500. That's on the session. On the year in the last 4 weeks, absolutely flying.